Welcome to the Homeowners chapter. We spent a lot of time learning the differences between dwelling and homeowners. Now we're just going to focus on homeowners insurance. It should go by relatively quickly since we already know the differences and we've got the gist of what's going on. A homeowner's policy is 1 to 4 units, and you have to live in one of the units. A 2-unit house would be a duplex, 3-unit triplex, 4-unit quadplex, but they have to be connected. If you have 2 properties on one piece of land, if they're not connected, only one of them can be homeowners. The other one would have to be dwelling insurance. So you have to live in the house for homeowners insurance. You can have 4 families per policy and 2 boarders per family. A boarder is somebody who is renting or staying with you. You can have a small business and a homeowner's policy, but you can only have 2 employees and you're one of the employees. So like if you have a barber shop out of your house, you can really only have one other person other than you running the barber shop. But it has to be a small business. If it's like an auto repair shop, that's a garage keeper. That goes into different insurance. We're talking insurance office, hairdresser, nail salon, something small out of your house. You can only have 2 employees, 1 including you. We have some definitions of an insured. A named insured was the person listed on the policy, and your spouse is also considered an insured. Anybody living in the house is considered an insured under your policy. So like if you have a nanny living in a spare bedroom, she actually lives there, she is considered an insured. If it's a resident employee, like a maid or butler, their stuff is covered under your house. Anybody under 21 in your house is also considered an insured. Section 1 of a homeowner's policy is known as property. Section 2 of any insurance is known as liability. Property insurance typically pays you and your family. Liability typically pays other people for lawsuits. You'll learn more about liability insurance further along in the chapter. Animals are not covered, meaning that if Fluffy the cat dies, you're not getting any money for Fluffy. That's something called pet insurance, which is not on the test. But if your cat kills somebody or your dog bites somebody, then you are covered for that liability claim. You're not going to get any money if your pet dies. Your location for homeowners insurance also follows you. If you have your stuff in a hotel room and somebody steals it, you're covered. If you have a secondary vacation home, you can add that onto your policy. Cemetery plots are covered up to $5,000 as well. A lot of people plan this stuff out and they'll buy like a gravestone. If somebody goes over and breaks your gravestone, you'll get $5,000 for it under homeowners insurance. We already talked about a resident employee. There's somebody who works on the house that's like a maid or a nanny or something like that. Now I like this chart. I spent a lot of time making this chart. This is the differences between the homeowners policies. The HO2 is a broad form policy. That means that your structure, coverage A, is covered for the broad perils, and your contents are covered for the broad perils. An HO2 is broad coverage A, broad coverage C. An HO3 special is special coverage A, structure, broad coverage C, contents. So like if a deer breaks in your back door and it gets cut and it bleeds all over your house, walls, floor, couch, TV, you got deer blood everywhere. If you're wondering why I picked deer blood, because it's memorable. The HO3 will clean the deer blood, fix the deer blood off your walls, floors, structure, but your couch, TV are not covered for the deer blood. So an HO3 is special broad. An HO5 is just like an HO3, but an HO5 is special special. An HO5 would clean the deer blood off of your couch TV and all that good stuff. So an HO5 is the best homeowners because it's special coverage A, special coverage C, but an HO3 is special coverage A, broad coverage C. The HO4 renter's policy, known as a tenant's policy, zero coverage A because it's a renter's policy, broad contents. Are you kind of noticing a theme? Broad, 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 broad. There's only one special contents. That's why an HO5 is the best comprehensive policy. So an HO4 is renters, no coverage A or B, yes coverage C. An HO6 is a condo. The difference between an HO4 and an HO6 is that you have to cover the structure on the condo because condominiums you own. It's like an apartment that you own. Since you have to cover the walls, cabinetry, toilet, bathroom, floors, the HO6 has broad coverage A, so that's your walls and stuff, broad contents. In the real world, the standard homeowner's policy is an HO3, that's what most people get. Renters get an HO4. If a person has a decent amount of money, they might buy an HO5 for their house. If they own a condo, you always give them an HO6 because that's a condo policy. In the real world, we don't really sell an HO2 because in the real world, mortgage companies don't accept broad coverage A. They typically want special coverage A. The differences are broad, broad, special, broad, zero, broad, special, special, broad, broad. An HO3 is the same thing as an HO5, except your contents are covered for everything. An HO4 is the same thing as an HO6, except you have to cover the structure because you own the condo. And an HO8 is a modified historic home. HO8s are using market value. You don't have to worry about what this one really is. As long as you memorize old houses, historic houses, market value, that's an HO8. Contents are typically actual cash value. Structure is always replacement cost, except on the dwelling policy 1, it was actual cash value. And the DP1, that's bad insurance. Structures, replacement cost, contents, actual cash value. You can endorse this up to replacement cost, but then you'll have the 80% co-insurance. We'll talk about that a little bit later. You have to pay extra for replacement cost contents. Homeowners insurance has additional coverages just like dwelling. Homeowners insurance will cover tree removal. If your neighbor's tree falls onto your driveway, your homeowner's insurance can pay for somebody to chop it up so you can leave your house. But if the neighbor's tree falls on your patio equipment, it's not covered. It's a little nuanced. Tree removal has to be blocking you, typically a driveway, from either getting into the house or out of the house. But if it falls into your house, you have to go through lawsuits and subrogation. So tree removal is covered as long as it's blocking your house. Dwelling insurance covered trees and shrubs up to $500. Homeowners covers trees and shrubs up to $1,000. Homeowners insurance will cover property removed to protect it for up to 30 days. So if you know a hurricane's coming through, you can take some of your stuff, load it into a U-Haul, take it up to Iowa, where I guess no hurricanes hit Iowa, put it in U-Haul, a storage unit for 30 days, then take it back after the hurricane's gone. Your homeowner's insurance will cover property removed to protect it for up to 30 days maximum. Homeowners insurance will actually cover the fire department service charge up to $1,000, but your test really likes to talk about the dwelling fire department service charge. That's why this says $500, because that's typically the test answer, because they're typically talking about dwelling insurance. But homeowners insurance will cover the fire department service charge up to $1,000, no deductible for homeowners. This is here because that's the dwelling answer, and that's typically what the test asks. Homeowners insurance also covers a loss assessment of up to $1,000. It's a memorization question. I will teach it, but an additional coverage under homeowners is a homeowner's loss assessment of $1,000. So let's say you live in a condominium building, and this is your condo. Down here is a gym. That's a treadmill. It's a guy running on a treadmill. If the gym burns down, don't worry, he got out. If the gym burns down, that's not really on you because you own the unit and you have to cover everything in the unit. There's something called a condominium master policy, which covers all of the common areas, like the hallways, the stairs, the lobby, the gym. The condominium master policy, which is through like a homeowners association, a condo association, that's what's supposed to cover the gym. But let's say that your condo building wasn't smart and they didn't have master policy insurance. If the gym burned down, then your building might assess you a fee to fix it. And they'll assess everybody the same fee. That way you have enough money to rebuild the gym. Your homeowner's insurance covers up to $1,000 to rebuild that gym. It applies to pools, because a lot of like condo places have pools. Homeowners associations have pools sometimes. They have like clubhouses you can rent out. If any of that stuff burns down or has a claim and they don't have a condo master policy, then you can file under your homeowner's insurance for the assessment fee that they charged you. Your test typically just asks you to memorize it. They'll say, how much is the homeowner's loss assessment covered for? And that is $1,000 assessment fee. Grave markers were already covered. Your gravestones covered up to $5,000 under additional coverages. So additional coverages are free coverages added on to a policy. We talked about this in dwelling insurance. We already know this, but we'll run through it relatively quickly. Homeowners insurance has coverage letters. Coverage A is real property. That's your structure. Coverage B is other structures. That's your shed. Coverage C is contents. That's your couch. Homeowners is a package policy, so you get all of the coverages. So like a homeowners policy coverage A covers the structure for say $100,000. Your shed is covered for $10,000. Even if you don't have a shed, your homeowner's insurance gives you coverage. Your couch, your TV, your stuff, contents, coverage C, personal property, is covered for $50,000, 50% of coverage A. If you only have $30,000 worth of stuff, you're only getting $30,000. If you have more than $50,000 worth of stuff, then you're going to get, then you have to up the coverage to get that coverage. These are just minimum standards that homeowners insurance has, because remember, homeowners is a package policy. A little bit later on, you'll learn that homeowners is similar to a business owner's policy, also known as a BOP. Homeowners insurance is a package policy where they give you these minimum standards. Coverage A also includes your lawnmower. Anything used, that's a lawnmower. Anything used to maintain your house or work on your house falls under coverage A. Coverage D is loss of use. That's fair rental value and additional living expenses. That was coverage D and E under dwelling. Homeowners insurance adds them together, so you automatically get coverage. Coverage D, loss of use, that's the name of it, is 30% of coverage A. So it'll give you rental income if you could have rented out a room, and it'll put you up in a hotel, which is additional living expenses. Now here's the cool part about homeowners insurance. Homeowners insurance automatically covers liability. Dwelling insurance didn't. You had to endorse on liability under dwelling. Section 2 of the homeowners policy is coverage E and F. This stuff follows you. So for example, let's say you're at your house and I visit your house and your dog bites me. Coverage E and F protect you from my lawsuit. Now let's say you're at the supermarket and you're walking your dog. Your dog bites me at the supermarket. Coverage E and F follow you. Primarily coverage E. But these insurance things, liability will follow you. So if you ever hurt somebody or get sued for something you did, you can file under your homeowner's insurance Section 2 policy. Liability is typically a minimum of $100,000. You can get higher. MedPay, medical payments to others, is $1,000. We'll talk more about them in a little bit, but Section 2 of the policy is coverage E and coverage F, which is liability and medical payments. You get this for free under homeowners because it's a package policy. Now I got a question for you. Let's say a renter, a tenant, somebody who has an apartment, installs a jacuzzi, that's a jacuzzi, a hot tub, in their apartment. What type of insurance did the renter have? That was an HO4. If the apartment burns down, what part of the policy covers the hot tub? The answer is none of them up here. Since the hot tub was permanently installed, it's not coverage C. But HO4s don't have coverage A and B. HO4s can have something called an additional coverage of tenant improvements. If the tenant improves something in an HO4, that is covered for free as well. So remember, the whole HO4 doesn't have coverage A deal. If they ever improve their apartment, they do get coverage under tenant's improvement. That's a tricky question on the test. They like to ask you which type of homeowner's policy has tenant's improvements, and that's going to end up being the HO4. That's an additional coverage. It doesn't actually fall under any of these. Homeowners insurance also places certain limits on things. Coverage C, this is what we're talking about, contents. Since homeowners insurance is a package policy that covers many different things, the insurance companies ask you to pay extra for certain things that are stolen a lot. So like your watercraft and trailers, boats, jet ski, things like that, $1,500. You can get more, you just have to pay for it. Jewelry and furs are capped at $1,500, but only if they're stolen. If a fire burns down, all your mink coats are gone, coverage C. But if somebody steals it, you're capped out at $1,500. We'll talk about what you can do to cover that in a little bit. Guns, $2,500 if stolen. People like to steal guns. If you've got expensive guns, you're going to have to pay attention to this a little bit later on. But guns are capped out at $2,500 if stolen. Gold and silverware, $2,500 if stolen. Business personal property. Personal property was coverage C. That's stuff, contents. Business personal property is like a work laptop that you took home. That's a laptop. If you take the work laptop home, somebody breaks in, steals the laptop. You get $2,500 under homeowners insurance. But if the work laptop is stolen out of your truck, you only get $500. So your homeowners insurance will cover business personal property up to $2,500 on premises, $500 off premises. That's supposed to be covered under business insurance, but remember, homeowners is a package policy, so they give you a lot of extra coverages for free. Homeowners also will cover $1,500 for electronics that are stolen from your vehicle. So like, don't leave your expensive laptop in your vehicle. Take it with you. Let somebody steal it out of your car. Not from your car, but somewhere else. So $1,500 for electronics, $500 for money, or else people would just be making stuff up and saying somebody stole their money all the time. So there's certain limitations on the policy. Your test loves to say all of the following have limitations except typically televisions, couches, things like that don't have limitations. Things that are stolen, I know TVs are stolen a lot, but things that are typically stolen a lot have limitations that can cost a lot of money. Here's another test question. $15,000 fur coat is damaged by an accidental discharge, bursting water heater. How much will homeowners pay? And it'll pay the full value because these only apply if it's stolen. So these don't apply to covered perils like fire and bursting water heaters, stuff like that. So you get the $1,500 for the fur coat if it's an accidental discharge. This stuff is difficult to memorize. It's not super important to memorize them. Now this is fun. Section 2 of your homeowners is probably my favorite part of a policy because this protects customers and they don't even know it. A lot of people would be like, well, I don't need renter's insurance because it's not my house or whatever I'm renting. And they're like, my stuff's not worth that much. But those renters should buy renter's insurance at least for the liability protection. Coverage E is personal liability. Coverage F is medical payments to others. Section 2, personal liability coverage E, will protect you from lawsuits. Let's say you like to shoot guns. You're at the range. You shoot your gun and it ricochets back somehow and hits another guy. Your liability insurance will protect you from his lawsuit. Let's say you get drunk, you go out clubbing, and some guy picks a fight with you, and you beat him up. Your liability will protect you. Section 2, personal liability, protects people from lawsuits from other people. So like if your dog bites somebody, if a child drowns in your swimming pool, if a kid gets hurt on your trampoline, if you buy vacant land and somebody trespasses, they fall, break their leg, still covered. Vacant land is automatically covered under Section 2, personal liability. So like if you have a hunting cabin or something like that, I shouldn't have said cabin, but if you have hunting land that you hunt on, it's empty, somebody trips and falls, your liability covers you. Liability protects you from lawsuits for bodily injury and property damage. It also comes with the coverage F, medical payments. Medical payments is its own separate coverage that in property insurance, home, dwelling, business, property, pays other people. Medical payments coverage F does not pay you or residents in your household. It has to be somebody visiting your house. So let's say you're having a party and you're on the deck and you got 9 other friends on the deck with you. 10 people on the deck, you're one of them. The deck falls, breaks, everybody's hurt. Your coverage F will cover up to $1,000 per person that's injured on your premises. So since there were 10 people on the deck, this would pay out $9,000 of medical bills, because remember, one of those people was you, and you don't get paid for MedPay. MedPay pays other people. Let's say your mother-in-law is visiting. She trips and falls and hits a glass table, cuts herself. MedPay will pay her. But let's say your 13-year-old son is in the backyard and he trips and falls and breaks his arm. He doesn't get any money. It's other people visiting you for property insurance. So it'll pay up to $1,000 of medical bills per person to other people, not you. They will have up to 3 years to get their $1,000. So like, let's say they use $500 the day after they got hurt. Then 2 years later, it gets infected, and I don't know how, but it got infected. They can use the other $500 for medical bills later. You have 3 years to collect your medical payments. And medical payments is known as no-fault coverage. What that means is, I can come to your house, I can take your knife and cut myself. Not your fault, I just went to your house, cut myself with your knife. You're going to pay $1,000 for my medical bills. Your homeowner's insurance will. There's no fault, means it doesn't matter whose fault, my fault, your dog, my dog, whoever gets hurt on your property, $1,000, no question asked for medical bills. The reason we have this is because the insurance companies are hoping if they cover this small amount of medical bills, the person won't sue and go into the $100,000 of liability. This has helped to help stop those small lawsuits from turning into big lawsuits. But remember, you can't collect, and resident employees and other people are only covered if they get hurt on the job. But if they're living there and they're not on the job, then they don't get covered. If your child gets hurt, not covered. It has to be other people. Now, a little bit later on, auto insurance medical payments will pay you and people in your car. So property insurance pays other people as long as they're not living in the household or not on the clock. But auto insurance pays you medical payments and other people in your car. So make sure you know the difference. Property insurance, home, business, dwelling, pays other people visiting you. Auto insurance will pay you and people in your car medical payments. So anyway, coverage E is personal liability. It's $100,000 minimum. You can get higher limits. Section 2 of the policy covers other people if they get hurt on your property. MedPay coverage F is $1,000 per person, no fault coverage, and they have up to 3 years to claim that money. This will cover their medical bills. It's not like they give $1,000 to the person. They give it to the doctor that fixed them. We covered this in a previous chapter, so we're just going to hit it real quick and then move on. Cancellation is sudden termination. During the first 60 days of any policy, they can cancel you for any reason. If you don't pay your bill, they have 10 days notice they have to give you. After 60 days, they can't cancel you unless you don't pay your bill or you committed fraud or you're doing something illegal. At the end of the year, if they don't want you anymore, that's called non-renewal, and they have to give you 30 days notice for non-renewal. Non-renewal means that you're not dropped today, but at the end of the year, then they don't want you. Typically, people get canceled in the first 60 days because of like tree branches over their house or gutters leaking or small things wrong with their house. We cover this in the dwelling chapter, though. Homeowners insurance has a few endorsements. These endorsements will likely be on your test. You pay extra for these. Homeowners insurance does not cover earthquakes, so you can endorse on earthquakes. In California, it probably costs a lot. I don't know how much, but it probably costs a lot. Earthquake insurance will cover all earthquakes and all aftershocks within 72 hours of one earthquake. Volcanoes, which are covered without an endorsement, were 7 days Earthquakes are 3 days, volcanoes are 7 days, but earthquake insurance covers earthquakes. If you have a home daycare, you can endorse that on and be covered under your homeowner's insurance, but you can only have up to 3 children, and it has to be a low-risk daycare. You can't take the kids on racing expeditions. Don't sexually abuse children. Animal attacks, not covered. You're talking about like if a kid skins their knee or something. Homeowners, home daycare insurance will cover. So you can endorse on a home daycare, but you can only have up to 3 kids at a time being seen, and it has to be a small minor injury. Personal articles is a big deal. When I learned insurance, I learned it as scheduled personal property. And that's what I call it, scheduled personal property. But scheduled personal property is the same thing as personal articles. Remember, certain things had limitations on them, like guns, jewelry, goldware. If you have expensive stuff, you added on something called a personal articles policy. So let's say I have a diamond ring. Let's say the diamond ring is $20,000. I want to insure that under personal articles, and it'll take the diamond ring out of coverage C. So I no longer have coverage C on it. And I'll buy its own separate policy called personal articles, also known as scheduled personal property. When you add things onto this, you remove it from the homeowner's policy and give it its own insurance policy that you pay extra for. So like a $20,000 ring would cost like $200 a year. But now that ring is covered on an all-risk basis on the agreed value. Because typically you have to have an appraisal to do this. So if you remember, contents coverage C is actual cash value, and it doesn't cover everything. It's broad. I want my diamond ring covered for everything, all risk basis, and I don't want ACV, I want the appraised value, also known as the agreed value. You insure expensive things on personal articles policy, you remove it from coverage C, add it on its own policy, and there's typically no deductibles and no coinsurance because you're paying extra for it. So whenever you add, whenever you sell somebody homeowners, you always ask them, do you have any expensive jewelry? Do you have any expensive guns? Do you have any expensive golf clubs? Blah, blah, blah. And if they say yes, 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 you ask them, would you like it to be insured by itself? And we'd schedule it on a separate policy for agreed value. Take it off coverage C, get its own policy. Most people do this. It's a good protection. It covers your items for everything except intentional losses. So like if I left my $20,000 diamond ring at the beach and it mysteriously disappears, coverage C, not covered. Personal articles, scheduled personal property, yes, covered. Let's say that, I don't know, I left it on the dining room table, came back home, it's gone. Covered, underneath personal articles and all that stuff. So it covers it for everything except intentional losses. So as long as I don't throw the thing down the street, I'm going to be covered. But the big thing is, in the real world, if you have like a 3-stone diamond ring, and you lose 1 stone, you're not covered. You got to lose the whole thing. So you got to make sure that the actual entire item is damaged. If one of the stones just fell out, mysteriously disappear the rest of the ring, that's a joke. Don't do that. But personal articles covers items on an all-risk basis, also known as agreed value. There's no coinsurance requirement, no deductible because you pay extra for this. That's where the expensive items are covered under a homeowner's policy. So that is the, we have one more slide. Now, if you remember, coverage C was actual cash value. You can endorse it up to personal property replacement cost. So instead of doing personal articles, you can always endorse it up to personal property replacement cost. In the real world, you do both. In the real world, you'll endorse their contents up to a replacement cost. And then in the expensive items, you add on a personal articles policy. But personal property replacement cost does have an 80% coinsurance. Anytime you do replacement cost, there's always a coinsurance requirement. Personal injury, you're going to learn in the commercial side. Personal injury protects against mental anguish and damage to reputation. So that's like false arrest, defamation, libel, slander, invasion of property. This is in the commercial insurance chapter. Mobile homes are the exact same thing as homeowners. Treat them as if it is a homeowner's policy, such as an HO3, meaning that coverage A is replacement cost, coverage C is actual cash value. They have all the additional coverages that homeowners has: property removed to protect it, 30 days, fire department service charge, $1,000, homeowner's loss assessment, $1,000. So mobile homes are the same thing as homeowners insurance. Your test tries to put them in there to make people think that mobile home coverage is not as good, but it really is the same thing as homeowners. So any question that applies to homeowners also applies to mobile homes. Now that we've finished this chapter, good luck. If you need to review, you can go back and look at the difference between dwelling and homeowners.